Audit and assurance. Until now, we have covered chapter 1, 2, 3, 4, 5. In previous lectures, we have covered about threats on independence. I mean, there are five types of threats that arises on auditor independence that auditor need to reduce to an acceptable level or to avoid them. What were those threats? Just in very much detail: self-interest threat, self-review threat, advocacy threat, familiarity threat, and intimidation threat. Even we covered some cheat as well. So let's look forward. What else we left in this chapter? We're gonna complete this chapter first, and then we will move towards the most technical chapter of our syllabus, chapter 6. So before accepting audit of any client, I mean, we are auditor. What we do, we conduct audit of financial statements of different client companies. So before accepting audit of different client or any client, we should perform some procedures. We should not accept the audit engagement blindly. We should perform the procedure before accepting the audit. Suppose any company, any client approaches us for conducting audit of their financial statements. So before accepting their proposal, we should perform some procedures. What would be the procedures? We should check whether we are qualified auditor or not. We should check our qualification. Qualification, we should check legally as well as ethical. Legally mean we should check the company we are going to conduct audit. Legally, we be disqualified if we are the shareholder of that company, if we are a partner of that company, if we are the employee of that company, or if we are employee of any partner or officer of that. We cannot conduct audit of those companies to whom we are the shareholder, we are the partner, officer, or employee. Legally, it is restricted. Not only we should check legal qualification, we should check ethical qualification. There shouldn't be any threats on our independence. If there is any threat on independence, ethically we are not qualified, we are disqualified. We should not accept audit of those clients. Before accepting audit for any client, we should check adequacy of resources. Adequacy of resources mean whether we are having appropriate resources to conduct the audit or not. Resources mean whether we are having a proper number of staff to conduct the audit or not, whether our staff is having the skills, knowledge, experience of conducting audit of this kind of company or not. Because if we are lacking in staff or lacking in skills, experience, we will not be able to perform quality audit. I mean, our quality of work will be affected, and might be we are going to express wrong opinion. And if we have expressed wrong opinion, we will be paying damages to the parties who made their decision based on our audit reports. So before accepting the audit, what we need to check? We need to check our qualification. We need to check adequacy of resources, whether we are having adequate resources to conduct the audit or not. Give me a moment, please. System is not responding properly. Give me a moment, please. There is issue with the system. Cyber insurance, yes, please. Okay. So before accepting audit of any client, we need to perform some procedures. What we need to perform? We should check our qualifications, both legally and ethically. And we should check adequacy of resources, whether we are having enough resources to conduct the audit or not. Resources mean whether we are having enough staff, whether our staff is having skills, knowledge, experience, whether we are having logistic, like if client is based on far location, whether we are having any transportation available or not, so that we can perform audit on timely basis. Before accepting audit of any client, we should check integrity of client management. Integrity means honest. The client, we are going to conduct the audit whether their management is honest or not. If they are not honest, if they are corrupt people, so there might be chances of frauds in the financial statement. And we being auditor do not verify 100% of the financial records. We perform procedure on sample basis. Mean we check less than 100% transactions. And if there are high chances of fraud because management integrity is doubtful, so there might be chances we will not be able to find or detect any of the fraud. And due to that, our opinion might be wrong. So we should check integrity of client management before accepting the audit. Before accepting the audit, we should check future viability of client. Give me a moment, please.
Just send me the last three letter number if it comes. Okay. Yeah. Mr. Ziana, sorry guys. So
So we should check future viability of client. Future viability, what does that mean? We should check going concern of the client. What does it mean by going concern? Going concern mean whether this company will continue its business in next 12 months or not. Because if suppose company is not going concern, this means this business will shut down within 12 months. So might be we will unable to recover our audit fee, our whole audit work will be lost. So we should check whether this company is going concern or not, because through going concern, we can maintain this client so many years. So before accepting the audit, we should check any limitation in scope of work. Mean whether client management will allow us access to records, whether they will provide all kind of information relating to audit, whether client maintain accounting records. This means we will be able to conduct the audit freely. If client management do not maintain record, they will not allow access to auditor. They are not providing all information to the auditor, mean there is a scope limitation. This means we will not be able to perform audit procedures. If we will not be able to perform audit procedures, we will not be able to take evidence to base our opinion. Mean we will not be able to express opinion. So we should check these things before accepting the audit. If there is any scope limitation, we should not accept the audit. Before accepting the audit, we should obtain professional clearance. What is meant by professional clearance? We should contact the previous auditor to whom we are replacing. Why he is not continuing the audit? Because normally one audit firm conduct audit for a company so many years. Suppose company is changing its auditor, mean you are going to be appointed as auditor of the company. So we should contact the previous auditor, ask him the reason why he is not continuing the audit. Might be that reason also affect us in future. So we should obtain professional clearance, mean asking the previous auditor the reason behind leaving the audit. Before accepting the audit, we should obtain client identity. Client identity mean we should get knowledge about the affairs of the company, like a company is a legal registered company is involved in a legal activities, there are no illegal activities involved in the company. We should take knowledge about the main representative of the company. There are no illegal mean wanted persons involved. Companies having a registered company, legal company, all the representative are of a good repute. So before accepting the audit, what we need to do, we need to check our qualification both legally, ethically. We need to check adequacy of resources. We need to check integrity of client management, future viability, mean going concern of the company, scope limitation. We should obtain professional clearance, and we should take client identity. If any of the matter is negative, we should not accept the audit. Otherwise, during audit, might be we are not finding proper evidence, might be we will be giving a wrong opinion, and after giving wrong opinion, we will be able to paying damages for the stakeholder who have made their decision based on our audit report. Suppose these procedures are okay, and we have decided to accept the audit. So after accepting the audit, what we need to do? First, we should verify that previous auditor removed properly or resigned properly. We should verify the previous auditor removed properly or resigned properly, or the professional clearance we have obtained from the previous auditor. We should check there was only that reason that he has provided us. So we should make sure the previous auditor resigned or removed properly. We should check our appointment is proper. Who should appoint the auditor? Shareholder, not directors. Only the first auditor directors can appoint, or if during the year auditor resign and to fill the casual vacancy, directors can appoint. Otherwise, the auditor should be appointed by the shareholder through special resolution at AGM. So we should verify our proper appointment, whether it is by the director. So director can appoint only first auditor, or to fill casual vacancy only. The subsequent appointment should be through shareholder. And we should sign a letter of engagement with the client. After accepting the appointment, we should verify the proper departure of previous auditor. We should verify proper appointments of are on, and we should sign a letter of engagement. What is letter of engagement? Letter of engagement is an auditor formal appointment letter, where auditor agrees certain terms of engagement with the client. Why? To avoid future misunderstandings. Who is responsible for preparing financial statements? Company management directors. Who should follow accounting standard while preparing financial statements? Company management directors. Who should implement internal control system in the company? Management directors. So we should agree these terms in letter of engagement so that management cannot deny from these responsibilities. We will agree with the management what will be our timetable for the audit. I mean, when we will start the audit, when they will prepare the financial statements, when we will sign the audit report. We will agree our audit fee with the client, when they will pay the fee, either fully after signing the report, after fully at year end, or some part before starting the work, some part at year end, and some part after signing the report. So that we can recover that fee accordingly, that appointment letter. We will mention our responsibility in this letter as well. Like being auditor, we will not provide any guarantee that financial statements are true and free. We will provide assurance. We will perform audit as per auditing standards. We will perform audit work based on sample rather than 100% testing. Or what else we require from the management, we will write down everything in this letter of engagement. So what is letter of engagement? Letter of engagement purpose is to avoid future misunderstanding and agreeing the term of engagement with the client. Purpose of engagement letter, I'm writing here, to agree the term of engagement, to agree the term of engagement with the client to avoid future misunderstandings. To agree the term of engagement mean regarding what matter management responsibility, what regarding what matter auditor is responsible, so that there shouldn't be any disagreement in the future. There are some contents of engagement letter that we should be aware of. What are the contents of letter of engagement? Formal, it is a formal acceptance of appointment of auditor, mean both parties will sign. We will mention the objective and scope of audit of financial statements. What is the objective of audit? To express opinion on the financial statements, whether they give true and fair view or not. We will not prepare financial statements. We will not conduct internal audit function. We will just express opinion on the financial statement. We will state the objective of audit in engagement letter so that there shouldn't be any confusion in management mind. You ask question based on the problem. Yeah, exactly. We should write responsibilities of management like preparation of financial statements, like implementation of internal control system, like providing access to records to the auditor is a responsibility of management. If auditor require any information relating to audit, management should provide that information. This is the responsibility of management. To prepare financial statements as per applicable financial reporting framework, mean accounting standards, it is a responsibility of management. We will mention auditor's responsibility. Like we are responsible to conduct audit as per ISAs, mean International Standard on Auditing. We will provide reasonable assurance. We will plan our audit work, then we will perform. We will state scope of audit. Scope of audit means a little bit detail about our audit. Like we decide our audit work based on evaluation of internal control system. If internal control system will be strong, we will perform test of control with reduced substantive procedure. If internal control system will be weaker, we will perform substantive approach. We have discussed this in very first lecture, very first page of our notes. In letter of engagement, we will state the applicable financial reporting framework, mean which accounting standard management should follow to prepare financial statements, either IAS, IFRS, or any local standards. Those standard reference should be put in the letter of engagement so that management should prepare according to those standards. We will mention expected form and content of audit report, mean what could be our audit report, what will be the elements of audit report in what situation, we will provide what kind of audit report. There are mainly two kind of audit report, qualified audit report and unqualified audit report. What are these? We will study later on in audit report chapter. And we will mention under letter of engagement. We will state that if during audit we will identify any of the weaknesses, we will communicate to management through letter of weaknesses. Like during audit, while performing test of control, if we are finding any weaknesses in internal control system, we will report to company management through letter of weaknesses. In engagement letter, we will write like in situation if we need written representation from management, we can require. What does that mean? Written representation from management. There are some account balance in the financial statements against which auditor cannot verify 100%. Or auditor cannot obtain sufficient audit evidence because those matters involving management estimate judgment. And for those matters, we require a written statement from management like this figure is correct as a extra evidence. And that extra evidence, written statement from management is called written representation from management. So we will state in the letter of engagement, in case we need any written presentation from management, we can obtain. Mean management will not deny in future. These things we will agree at start of the audit work. Receivable amounts. It may be a receivable amount depreciation where management estimates is involved. Along with audit, if we are providing other services, how we are maintaining our independence, we will state in letter of engagement. I mean, what other services we are providing along with audit, but for other services, there should be separate letter of engagement. This letter of engagement is relating to audit only. But if we are providing, we will state here how we are maintaining independence. What could be our basis of fee? Mean total fee when management will provide us a fee, it should be written in letter of engagement. And what will be the complaint procedures like if auditor want to complain regarding any matters for client company, to whom they can make complaint either to management, either to audit committee, either to those charged with the governance or directly to shareholder. It must be written in letter of engagement. But these are the main components of letter of engagement: the objective, management responsibility, auditor responsibility, scope of audit, and identification of financial reporting framework. These are the additional contents. So before accepting audit of any client, we should perform some procedures. We should not accept the audit blindly. If these procedures are okay, we should accept the audit. And if we have decided to accept the audit, after accepting the audit, we should check proper departure of previous auditor, proper appointment of on auditor, and we should sign a letter of engagement with the client. What is letter of engagement? A formal appointment letter of the auditor. The purpose is to agree term of engagement with the client to avoid future misunderstandings. What are the contents of letter of engagement we have discussed? Before signing letter of engagement, we should agree preconditions for audit with the client. Before signing letter of engagement, we should agree preconditions for an audit with the client. What are preconditions? Preconditions mean management responsibilities. And there are 5 preconditions mean management responsibilities. What are those? Preparation of financial statement is the duty of company management. Implementation of internal control system is the duty of company management. To provide all information relating to audit to the auditor is the responsibility of management. Management cannot deny to provide any information if auditor is asking for audit purpose. To allow unrestricted access to company records for audit purpose is the responsibility of management. They cannot restrict auditor to have access to company records. And the 5th one, before these four, we should discuss with management the applicable financial reporting framework. Applicable financial reporting framework mean which accounting standard management comply to prepare financial statements, either IAS, IFRS, or UK GAAP, USA GAAP, or companies auditors. Because in some part of the UK, they prepare financial statements as per UK GAAP. In some part of the USA, they prepare financial statements as per USA GAAP rather than IAS, IFRS. Even in some countries like India, Pakistan, 10 years back, they prepare financial statements as per companies
Can you repeat that?
Ordinance 1984 rather than IAS, IFRS. So we need to agree the applicable financial reporting framework with the management. We need to agree the preparation of financial statement is the responsibility of management. Implementation of internal control system is the responsibility of management. Providing information relating to audit to the auditor is the responsibility of management. And providing unrestricted access to company records for audit purpose is the responsibility of company management. Preparation of financial statements, implementation of internal control, information relating to audit, and access to records. The examiner could ask preconditions separate in an MCQ. So what are the contents of engagement letter we have discussed? What is the purpose of engagement letter we have discussed? And we have discussed a separate topic called preconditions for an audit. If these preconditions are not existing, mean management is not accepting any of the responsibility, we should not accept the audit engagement because these things are necessary. And these are the main management responsibility that we agree or write down in letter of engagement as well. Can you understand this? Okay, let's move towards two more small topics. Then we will move towards some questions. There is a topic called tendering. This is a tendering. Tendering. Suppose if a company want to buy any of the asset, like non-current assets, big asset, large asset, what the company do? They open a tender. Open a tender mean they advertised in the newspaper or in the media and call quotations from different suppliers. Like they will advertise, we want to buy these assets in these quantities of this quality. And they are inviting different bidders, mean different suppliers to put their bid. So different companies will put their bid, their offer. We can provide you this asset of this quality with this price. Other will say we can provide you this asset with these features with this price. Third will say we can provide you this company asset with this price. Company will see who is providing best quality with the lowest price. Company will order to that supplier. This process is called tendering to buy asset. Some companies appoint their auditor through tendering process as well. And if they want to appoint auditor, they will advertise, they will publicize in the newspaper, in the media, we want to appoint our auditor. So different firms, please send us your proposal. So different firms will send their proposal. Like we are this audit firm, we are having these clients, we are operating from these years, we conduct audit this, and we will charge this audit fee. Other firm will provide their proposal. We are having these clients. We are operating from these years and we conduct audit according to this approach and we will charge you this fee. Now the client company will see who is the audit firm is having better approach and conducting audit at lowest fee. In fact, they simply see lowest fee. They don't care about how they are performing audit because they just need audit report because it is legally required. So they will see who is the auditor, who is charging lowest fee. They will appoint him as auditor. And to get audit of this client, every firm will try to charge very low fee. Because in reality, audit firms are not earning profit through audit. They are earning their revenue through non-audit services to the clients. Like accountancy services, internal audit services, taxation services, business consultancy services. They are generating money, revenue from non-audit services. Audit, they are not generating too much money. Out of their total revenue might be 20 to 25% they are generating through audit. The other is through non-audit sources. So every firm will try to capture this client for audit, and they will not get benefit through audit. They will get benefit by providing non-audit services in future to this client. But helps them build their reputation. But it's reality. Yeah. So every firm will try to capture this client to charge a very lowest fee. And charging a very lowest fee to the client is called low balling. What is low balling? Charging lowest fee. To audit client against other firms. In every firm will try low balling to capture this client. So if you are going to submit a tender proposal, so before submitting tender proposal, firm should perform some procedures. Mean they need to check few things. What are the things? First, they need to check ethical qualification. Mean they need to make sure their independence. Like if we are going to conduct audit of this client, there is no issue on our independence. Like might be you are providing some non-audit services with this client before, now you are going to conduct audit. So there shouldn't be any threat on independence. Mean you need to check ethical qualification, ethical requirement. Whether you are following all codes of ethics, and there shouldn't be any threats on independence. Secondly, they need to check adequacy of resources. Whether we are having enough resources to conduct audit of this client. Resources mean whether we are having enough staff and whether we are having skills, experience, knowledge relating to this type of company to conduct quality audit. If your staff haven't performed audit of this kind of company in past, so you are not having adequate resources, you will not be able to perform quality audit. You might be affecting your audit quality and moving towards giving a wrong opinion. And one wrong opinion can destroy your whole life. Being auditor, one wrong opinion can destroy your whole life. How? Let's discuss a scandal called Enron. Have you heard this Enron scandal before? What was that Enron scandal? The audit firm was, I think, Marillion. No, it was the name, but they were participating with Enron's board of directors. They basically cooked up the books. They made. What happened in 2002? In 2002, there was a big corporate fraud happened in USA. And that big fraud called Enron fraud. Enron was a large giant company in USA, mainly energy-based company having thousands of employees in the USA. Not only Enron was operating in USA, they were operating all over the world. I mean, they were having different customers, their intermediary, their suppliers all over the world. In 2002, while preparing financial statements, Enron company management made a fraud in financial statement. What kind of fraud? They omitted $7 billion liability from the financial statement. Mean they didn't disclose $7 billion liability in the financial statement. In company bought some asset on leases And if you are having asset on a leases, you need to show asset as well as liability both. They showed the asset, but not the liability. They omitted $7 billion liability from the financial statement. Why? To strong financial position of the company. What will be the benefit to show strong financial position? If you will show strong financial position, investor will be attracted towards the company because companies are having more assets, less liabilities. So company is performing very good. They are having very strong financial position. So investor will invest more in the company. And if more investors are attracting to the company share price will go up, because there will be more demand of company shares. What happened before producing financial statements? Director bought the shares of the company at lowest price. Why they made this fraud? Because after producing good financial statements, the investor will be attracted. We will be able to sell shares at high price. At that time, there were big 5 audit firms in the world. Now there are big 4. Who are big 4? Who are big 4? PwC, Deloitte, KPMG, and Ernst and Young EY. At that time, there were big 5 audit firms. The big 5 name was Arthur Anderson. I mean, these were the big 5 audit firms in the world at that time. Now there are big 4. Arthur Anderson was auditor of Enron. They were aware there is a $7 billion liability omitted from the financial statements. Financial statements are not true and fair, but they expressed opinion in favor of the company. I mean, they said financial statements give true and fair. I mean, they were also involved with directors for making fraud. So when company financial statements produced available for public, investors saw, oh, huge performance for the company. They made huge investment in the company. Everybody is demanding company shares. Everybody is demanding company shares. There were headlines of this company performance. Bank saw the financial statements and he realized they took asset on leases from me. If company performance is that much good, they haven't paid me the lease amount. When they saw the financial statements, they checked as compared to previous year, company have increased the asset, but the lease liability is not there. They disclosed that. It made headlines. So what investors doing now? They're trying to withdraw their investment when there is a huge supply of company shares, but there were no demand. So company become bankrupt, insolvent. Thousands of employees lost their job. Not only this company, their other associated companies, supplier, intermediary, customer, working all over the world, their businesses also closed down. And this was a very big scandal that disturbed the economy around the world, not only American, around the world. And there was a big recession from 2002 till 2008. There was big disturbance in a business industry. Recession continued till 2008, even after that. Some countries recover in 2009, 2010, and some even suffered after that. After investigation, it was found Arthur Anderson were also involved in the fraud. So their license is cancelled all over the world. Their client left this audit firm because they are not reliable auditor. Since then, Arthur Anderson business closed down. And now we are having big 4. I mean, one office wrong report have affected the big 5 business all over the world. So that's why before accepting the audit, we should not accept the audit blindly. Because if there are some problems due to which we were unable to identify evidence, take evidence, and we are expressing wrong opinion, our whole life will be damaged. So that's why while submitting proposal for tender, obviously we are trying for lowballing to capture this client, but before submitting proposal, we should check ethical requirement and we should check we are having adequate resources to conduct the audit. Obviously, if we are sending tender proposal, we try to impress the client. So we will say our company profile, mean our audit firm profile. We will provide detail of our audit staff member, mean what are the staff member we are having, how much is their experience, where they come from, what are their qualification. Might be we are attaching CVs of our staff members, and we are providing detail of other bigger client as well to impress the client. And we will explain our audit approach, mean how we will conduct the audit to impress the client. There's another topic that we need to discuss, that is quality management. An audit firm should maintain the quality of its work. How audit firm can maintain the quality of its audit work? By following 7 quality control policies procedures. An audit firm should maintain quality of its audit work. How they can maintain quality of its audit work? By following 7 quality control policies procedures. Quality control policies procedures. Who defined these? There is an auditing standard, ISQC1, international standard on quality control. One, they have defined 7 policies that every firm must follow to maintain quality of its work. What are the policies? Leadership responsibilities, ethical requirement, human resource, acceptance, and continuance of engagement. Monitoring, adequate documentation, what else? I forgot. Engagement performance. Engagement performance. So to maintain a quality of audit work, a firm should follow 7 policies of ISQC1, mean these are the quality control policy procedures. Leadership responsibilities mean there should be a leader of the firm. In every firm, there should be a leader who will ensure compliance of law, regulation, and standard in audit work. Who will ensure every auditor is working as per standard, as per law, regulation. Because if there are no leader, people don't follow the rules. Like in our house, if our parents are there, we try to be very punctual. We went back home on time, we leave on time. If parents are not there, we don't care about punctuality. We try to be going home late because nobody is there to monitor, there nobody to ask. So there should be leader of the firm. Ethical requirement, every firm should meet ethical requirement, mean they need to follow codes of ethical codes, ACC codes of ethics, and they should reduce or avoid the threat on independence. Human resource, every firm should have appropriate human resource. If they are not there, you need to recruit more human resource. You should train your human resource. Not only you should be having human resource, you should update your human resource, mean there should be CPD arrangements regarding updating their knowledge. Acceptance and continuous of engagement. To accept audit of any client, you should perform certain procedures that we have discussed, procedure before accepting the audit. If those procedures are positive, you should continue the engagement. Otherwise, you should not accept the engagement. Engagement performance means there should be proper direction of audit work. Mean before starting the audit work, there should be audit planning. Before starting the audit work, you should prepare audit strategy. And you should define audit plan. What is audit strategy? What is audit plan? We will discuss in next chapter. Our next chapter is completely on audit strategy and audit plan. So there should be proper direction of the audit. Every member should be aware which area they are going to audit and how they are going to audit and when they are going to audit. If every staff member is aware their role responsibility, we will be able to conduct quality audit. If there is no direction of audit team members are not aware of their role responsibilities. Might be they are missing some of the areas of financial statements to take evidence. So we will be expressing wrong opinion due to lack of evidence. There should be monitoring of audit work. If senior, junior are working on some area, who should monitor their work? Audit manager. And the complete auditor team work should be monitored by engagement partner. And if audit is completed, an independent partner in the firm should review the working paper whether team has performed work properly or not. Mean there should be review of audit work. How we can perform review of audit work? Through audit working papers that auditor prepare while performing work. And there should be two types of review. One is called hot review and other is called cold review. There should be two types of review of audit working paper, hot review and cold review. What is a hot review? Hot review is a review of working paper before signing the audit report. Who signed the audit report? Engagement partner. So before signing the audit report, he should review the working paper. He should see whether team has obtained all the evidence, whether all the planned work has been completed properly. There is no work left, and after that, he should sign the audit report, making sure everything is proper. That is called hot review. What is code review? Code review is after signing the audit report. If the audit report has been signed, mean audit report has been completed properly, an independent partner who is not part of this audit should review the working paper of this audit client. Like if there is anything lacking, he can highlight so that audit team should avoid these things in future audit. Who will perform the code review? Independent partner. Independent partner means that partner who is not part of this audit. This is also called QCR, quality control review. To see whether team has performed quality audit or not. If they haven't performed quality audit, things will be highlighted so that these things should be avoided in future audit. These are necessary. Not every year, every 3 years, firm must have performed QCR from independent partner. Who could be the independent partner? Some firms have appointed a quality control reviewer in the firm, whose role is to check quality control of audit working paper. Or you can perform this from any other office of your firm. They will perform QCR of your audit, you will perform QCR of their audit. So there should be two types of review of audit working paper: hot review before signing the audit report, and cold review, QCR, after signing the audit report through any independent partner. So to maintain quality of audit work, there should be leader who should ensure compliance. There should be ethical requirement, firm should follow codes of ethics, avoid threats on independence. There should be proper human resources. Before accepting client, you should perform some procedures, and audit work should be directed properly. And there should be monitoring as well as adequate documentation. You need to prepare working paper of your audit work. Not only you need to prepare working paper, you need to keep these working paper in record for coming 5 years. This is audit class. Audit.
Really? Why?
This is audit class. So adequate documentation means the firm need to prepare working papers. Not only they need to prepare, they need to keep in records for next 5 years. Why? This is the base for your opinion. If any person in the public say your opinion is wrong, how you can justify your opinion is accurate? By showing these working papers. See, rascal, I have performed these procedures, I have obtained these results, and based on these results, I have provided this opinion. Now you can prove how it is wrong. If you don't have working paper, you cannot justify your opinion against any rascal.
Do they keep the company information for 5 years?
Exactly. Because company information is included in working paper.
Even classified information.
Exactly. That's why they should be kept confidential.
Working papers are not released.
No, these are auditor internal documents. Auditor will never public these working papers, because all the company business secrets, their information, even their records, copies are in working paper. We will cover this topic in more detail in coming chapters. Working papers, what are the files, what are the contents, etc. So now our chapter 5 is completed. So let's move towards some questions from the kid. Question 56 on. The following scenario relate to question 56 to 60. There will be 5 MCQs from this scenario. You are the audit manager of a Rivers and Company. This means Rivers and Company is audit firm where you are audit manager. Your firm has been invited to tender for the audit of 7 company, a listed company. You are going to submit a tender proposal for any client. That name is 7 company. Your firm does not have any other listed clients, and 7 company will represent the biggest client of your firm. That is a big company. by client annual revenue if your tender is successful. Mean there could be some fee dependency issues. A member of audit committee of 7 company informed your audit engagement partner that the current auditors were not being invited to stand for re-election as the audit committee felt that the relationship between the firm and the company had begun to lose objectivity due to over familiarity. And they have informed company is not appointing their previous auditor. Current mean the previous auditor to whom you are replacing. Why there is issue of objectivity like there is familiarity threat. You have reviewed that financial statements of 7 company and have noted that the company applies IFRS and that the audit committee reports on its responsibilities with regard to internal control annually. I mean, who is responsible for internal controls review? Audit committee. The directors confirmed that the board would be happy to confirm their responsibilities in writing that reverse company audit firm as they are aware of the relevant audit requirement. Mean they will sign engagement letter, they will agree preconditions for it. Question 56. The audit engagement partner has asked you to prepare some information ready for the tender. And you are going to submit tender proposal. Identify by clicking on the relevant box in the table below if the following items should be included in or excluded from the tender for the audit of 7 company, mean which things you will include in the tender document, mean tender proposal, and which you will not include. The proposed fee for the initial audit of 7 company. Yes, because based on fee, client will decide to whom they should appoint auditor. A description of the reverse company mean audit firm, including the curriculum vitae means CV of the key staff likely to be assigned to the audit client. Obviously, you are going to impress the client, so you will state the CV of your audit staff member. Overall level of materiality to be used in the audit. What is materiality? We will discuss later on in next chapter. We have discussed about it, but a little bit in first chapter. So materiality level, we never ever include in tender because this is audit approach based and it vary from client to client because it is calculated based on company profit and every company is having different profit. So materiality level, we cannot state in tender document. A summary of potential other services river company could provide to 7 company mean what other services we can provide to client. Not to you, but we offer to different clients. So regarding firm profile, we should also include so that in case in future this client need any other services, they can contact us.
But then they will just stop audit.
This will be included. Though we are submitting tender for audit, but while explaining company profile, firm profile, we should explain everything what we do. Though we are not offering to this client, but in future, if they need, we can provide it through Chinese wall, something like that. It. Question 57. You have identified a number of issues which should be considered prior to tendering for new client. Given that you already know of 7 companies, which 2 of these are most important to consider further prior to tendering for the audit? What you will consider before submitting tender proposal? The firm is independent of the potential client. Obviously, you need to check ethical requirement mean your independence. The firm has the appropriate resources to conduct the audit. Yes, you need to check adequacy of resources as well. The preconditions of audit will be met. No, this is after accepting the audit. You will agree management responsibility and then sign engagement letter. These are not before even accepting. The ongoing auditor will give Rivers company access to working paper. No, auditor never ever provide access to working paper because these are secrets. These are auditor specific. So only 1 and 2. Obviously, we need to click 2 options. 58. You are reappraising whether it is appropriate for the firm to accept the engagement. Which of the following issues arising would cause River and company to decline the engagement? In what could be the issues against which you will decide to decline, not accept this contract? The engagement letter not being received by River and company. Obviously, if there is no appointment letter, you will not accept the engagement. River and company losing a major client, meaning a 7 audit fee would represent 20% of the annual firm income.
Yeah,
For 1 year is okay. So this will not be the reason because you can manage for 1 year. A reply from the outgoing auditor stating that they declined to seek a reappointment to the audit of 7 company due to disagreement over accounting policies. The previous auditor say there was disagreement over accounting policy. That's why I'm not going to accept this continued audit of this client. Obviously, we should also decline. Otherwise, who will also be resigning in future? This is a major issue. A request from 7 company that the audit be carried out in March when Rivers company already work at maximum capacity. No, these things we should manage according to our resources. So the main reason is this, against which we should not accept the audit. Procedure before accepting the audit.
you said could be first also.
First, the engagement letter not being received by River and company. If not received, we can request. Obviously, without this appointment letter and agreement, we cannot start audit work. You know, a company cannot ask you need to conduct audit without engagement letter. No. If it's not being received, we can request. In fact, we prepare and ask the client to sign this because we need to agree terms. 59. You are drafting an engagement letter in respect of 7 company when you are going to prepare engagement letter and are aware that ISA 210 term of audit engagement requires certain issues to be included. And we are aware about contents of engagement letter. Indicate which of the following issues must be included in the engagement letter. Scope of audit. Yes. Responsibilities of management of 7 company. Yes. Timetable for the supervision of accounting information by 7 company. Timetable of provisions of accounting information by 7 company. No, this is not. This is an internal matter, not relating to client information. Fees and billing arrangement. Yes, this we can include.
Yes.
When they will pay, what could be the fee basis for fee? Question 60. Before accepting the audit of 7 company, River and company mean audit firm should appoint a quality control reviewer, obtain reference concerning the directors, or submit the letter of engagement before accepting the audit. What they need to do before accepting the audit. Letter of engagement is after accepting the audit. Appoint a quality control reviewer is not necessary if there is no threat of independence. So what we need to do, we need to take identity of client. Identity of client means knowledge of the company, knowledge of the directors, their major representative. So references concerning the directors. And we should ask people regarding integrity of client management. And once the audit has been accepted, then Rivers and company should begin to submit the letter of engagement to agree term of engagement. Is that fine? Moving towards the next question. The following scenario relate to question 61 to 65. You are an audit manager in a NAB and company. This is your firm name. A large audit firm which specializes in the audit of retailers. The firm currently audits a Goofy company, Goofy, a food retailer, but Goofy main competitor, Mickey company, Mickey, has approached the audit firm to act as auditors. I mean, you are auditing Goofy and now its competitor, Mickey, has asked to conduct audit. This means you are going to conduct audit for both competitors. There will be conflict of interest, will create self-interest threat because confidential information may leak out between clients. We should first obtain permission from the client by informing them. Then we should create Chinese walls. Chinese walls means separate team from different offices. There should be written agreement with our audit staff member not to disclose information with each other. If both clients agree, we should continue both with the strong Chinese walls. If one of the client do not agree, we should continue one and decline others. Either we should decline Mickey and continue with the Goofy, or we can accept Mickey and resign from Goofy based on financial. Okay. So you have been approached by Mickey to conduct their audit as well. Both Goofy and Mickey are listed companies. Goofy is concerned that if NAB and company audit both companies, then confidential information could pass across to Mickey, and they have raised the concern. The audit engagement partner for Goofy has been in place for approximately 6 years. Is there an issue?
Yeah.
Familiarity threat due to long-standing relationship. And her daughter, whose daughter? Engagement partner daughter. Emma has just accepted a job offer from Goofy as a warehouse manager. Again, familiarity threat because your daughter is working in the client company. Emma's employment contract stated that if a bonus is to be paid, it will be awarded as a share in Goofy rather than in cash. And if she will get that bonus in share form, she will become a shareholder. And you are going to conduct audit of a company to whom your daughter is a shareholder. This will create self-interest threat as well. You will not be expressing opinion against the company. Otherwise, shareholding of your daughter will be lost. Self-interest. Okay. Goofy is offering NAB and company a 5% bonus on top of the audit fee if the year's audit can be completed 3 weeks earlier than last year. Gain self-interest threat. Percentage fee. This is to reduce the demand on the finance director's time as he is busy working on other projects. Not accepted. So there are two familiarity threat and two self-interest threat. Okay, first question 61. The ACCA Codes of Ethics and Conduct require that an external auditor implement appropriate safeguard to ensure that a conflict of interest is properly managed. Conflict of interest if you are auditing both companies. Which two of the following actions should NAB and a company take regarding the potential confidentiality issue? Inform the audit committee of both Goofy and Mickey of the potential conflict of interest and obtain their consent to act for both parties. Yes, we should inform them. If they agree, then we can continue both with strong Chinese walls. If we are conducting audit without Chinese walls or informing both, we are working in self-interest. Use a separate audit team for each audit with a common independent reviewer partner. Team should be separate, but reviewer partner should not be common, should be separate to determine whether confidentiality has been maintained. Draw up confidentiality agreement to be signed by the board of directors of Goofy and Mickey. No, confidentiality document should be signed with audit team members rather than with the client. I mean, they should not disclose information with each other. Prevent unauthorized physical access to the information relating to both companies' audit. Means staff should be from separate offices. Why not B? Because the independent partner should also be separate. And we never sign confidentiality agreement with the client. We sign with our staff member. 62. From a review of the information above, your audit assistant has highlighted some potential risk to independent in respect of the audit of Goofy. Indicate the appropriate category to which each of the threat to independence should be allocated. 1, 2, 3, 4. Can you identify which is familiarity threat and which is self-interest threat? Number one, the audit engagement partner has been in position for 6 years. Audit engagement partner's daughter worked for Goofy.
That is also familiarity.
Audit engagement partner's daughter bonus would be in the form of shares. Self-interest.
Interest.
Because your daughter is a shareholder. If you will find problems in that company, highlight weaknesses, ultimately her share value will go down. And 5% bonus offered if audit is completed 3 weeks earlier than last year. Again, self-interest. No, self-interest. Familiarity, family, friendly relation, or long-standing relation.
Okay.
63. NAM and company has decided that it would like to accept a nomination as Mickey's auditor. And Mickey's existing auditor have agreed to resign rather than removed from the office. And they have decided if previous auditor resign properly, then we will accept the audit. He should not be removed unfairly. The audit manager in charge of the tender has set out a list of procedures that the firm must undertake before Mickey can be appointed as an audit client. Ensure that the existing auditor resignation has been properly conducted. Communicate with Mickey's existing auditor, mean obtaining professional clearance. Submit an engagement letter to Mickey's management. And perform client screening procedures, including an assessment of Mickey's risk profile. Drag each of the 4 options below to right-hand side to show the correct order in which the above procedure should be undertaken. Drag each box from left into position to match the relevant box to the right. Mean which should be number 1, which should be number 2, which should be number 3, which should be number 4. What you will do first? Ensure auditor is resigned properly. This is after accepting the audit. Communicate with Mickey's existing auditor. Yes, this is before accepting the audit. Submit a management letter of engagement. This is last. And perform client screening procedures. This should be before accepting the audit. So I think this should be number 1. This should be number 2. This should be number 3. And then we should submit the engagement. First, we should obtain professional clearance. If professional clearance is okay, this means we have a made mind, then we should check client profile integrity, mean client screening, client identity. It's a legal company involved in legal activities. Their representatives are legal rather than wanted illegal persons. You can do this as first. But this is client identity. According to those procedures, professional clearance was before than this. Because this take time. If there is any issue with the auditor, you should not go for these things. You should not waste time for these things. Number 64. Before NABED company accept appointment as Mickey's auditor, it must determine whether the preconditions for an audit are met and obtain management agreement that it acknowledge and understand its responsibilities. Preconditions, there were 5. Applicable financial reporting framework, preparation of financial statements, implementation of internal control system, information relating to audit, and access to records. Which of the following is not included in an agreement before by the auditor? Mean which of the following is not preconditions for an audit? So management responsibility for preparation financial statement is there. Management responsibility for internal control is there. Management responsibility to provide the auditor with all information is there. Management responsibility to prevent and detect fraud.
Detect
No,
fraud.
this was not the precondition. And number 65. Indicate which of the following statements are true regarding the regulation of the audit profession. The auditor has the right of access to the books, records, and vouchers of the company. True.
True.
The auditor has a right to be heard at a general meeting of a matter relating to the audit. Yes, this is the right of auditor. He can attend meeting he can speak at the general meetings. The auditor is appointed by and answerable to those charged with the governance of the company. Those charged with the governance of the company mean company top management, audit committee, chairman, CEO. No, he is appointed by shareholder. He is accountable to shareholder. The auditor can be removed by a simple oral resolution. No, there should be written special resolution. Special resolution mean majority shareholder voting. Majority mean 75% or more. He cannot be removed by oral resolution. So this is also false. Let's take a break. After break, we will start chapter 6. Everything is available on team. So let's start chapter 6, planning and risk assessment. Audit planning. ISA 300. An auditor conduct audit according to auditing standards. Those auditing standards are called ISAs, International Standard on Auditing. There's an auditing standard ISA 300, and according to ISA 300, an auditor should plan his audit work before starting. I mean, before starting the audit work, there should be audit planning. If there will be no planning, you will not be able to complete audit within time, within cost, or perform quality. I mean, before starting the work, you should set a direction of the audit team. Every member of the audit team should be aware which area they need to conduct audit and at what time. So before starting the audit work, there should be audit planning of the audit work so that audit work can be completed within time, within cost, and on quality basis. And there are two main activities of audit planning. That is to define audit strategy. That is to define audit strategy and prepare audit plan. There are two main activities of audit planning: defining audit strategy and defining audit plan. What's audit strategy? Audit strategy means to highlight risky areas and direct the work of auditing. Audit strategy means to highlight risky areas and direct the work of audit team. Means through strategy, we will highlight risky areas. Risky area means areas in the financial statements where there are high chances of misstatement, where there are high chances of errors or frauds. So we'll highlight at the planning stage so that on those area, audit team should work more, should perform procedure in more detail, because there are high chances there could be misstatement. And against those risky area, we need to define audit plan. And what is audit plan? It is a detailed procedure plan. Detailed procedure plan about how to conduct the audit. About how to conduct the audit. Mean it is a direction of audit team. Mean which area should be tested by which staff member and how they should test that. Mean what kind of procedure they should perform on that account. So before starting the audit work, we should prepare audit strategy and audit plan. Mean there should be audit planning. How we can highlight risky areas in audit strategy? We can highlight risky areas through understanding the entity and its environment. We can highlight risky areas through analytical procedures. We can highlight risky areas through risk assessment. We can highlight risky areas through determination of framework. And by highlighting risky areas through these procedures, we will be able to define audit plan. What is an audit plan? Audit plan includes identification of critical areas, defining preliminary materiality levels, defining nature, timing, and extent of audit procedures, and brief the plan to audit team. So what involve audit strategy to highlight risky areas and direct the work of audit team? How we can highlight risky areas through understanding the entity and its environment. We need to take knowledge of the entity, company to whom we are going to audit and its environment. Because through this, we will be able to highlight high risk areas. What does that mean? We need to take knowledge of the company regarding nature of the company. Because according to knowledge of nature of the company, we can highlight high risk areas. If suppose company nature is a manufacturing company. In manufacturing company, there are always high chances of a misstatement in inventory because inventory is normally a big account balance. So this means inventory is a high risk area. If the suppose company nature is a service business, not manufacturing, and in service business, inventory will not be high risk area. Either income or expenses could be high risk area. So we should obtain a knowledge about nature of company. Because through this, we will be able to highlight high risk areas.
Analytical features.
We're gonna discuss later on. First, we are discussing about understanding the entity environment. What does that mean? We need to take the knowledge of that company to whom we are going to audit and its environment. Environment means industry market where that company is operating. We need to take knowledge about the internal control system of the business. Whether the internal control system is strong or weak. If the control system is strong, there are lesser chances of fraud and errors. We need to just check in detail only the large account balances whose amount is material, big from financial statement point of view. But if we have obtained knowledge about internal control system, that internal control system is weak. This means there are more chances of fraud and errors, not only the large account balances, even a small account balances could also be misstated. This means we need to check every account balance in detail. We need to perform more detailed procedures. Understanding the entity environment means obtaining knowledge about nature of the company, obtaining knowledge about internal control system of the company. We should take knowledge about industry regulations. The law regulations that should be complied by the company. Because if company is not complying with law regulations, there could be chance of misstatement in the financial statement. If company is not complying with law regulation, there are chances of fines, penalties imposed on the company. And no company will try to disclose those fine penalties in their financial statement to maintain their repute. So there could be chances company is not disclosing fines, penalties in the financial statement. We need to take knowledge about company objective its strategy, and its business risk. Because through this, we can also highlight high risky areas. Business risk, suppose company has invested huge amount in property and there is a slump in property. If there is a slump in property, there are chances that company assets should be impaired. So there might be chances of company not recording impairment losses. Either profit asset could be overstated, expenses understated. So we can highlight high risky areas like property asset is high risky area. We should take knowledge about management methods used to measure performance. In how company management performance can be measured against which they will receive their bonus. Either management performance is based on company profitability or based on strong financial position. If it is based on profitability, this means income could be overstated, expenses could be understated. These are high risky area, not the balance sheet item. If their performance is based on strong financial position, income and expenses will not be high risky area. Assets could be overstated or liability could be understated. These could be high risky areas. So what is meant by understanding the entity and environment, taking knowledge about nature of the company, internal control system of the company, industry regulations, business objectives, strategy, and business risk, and management method used to measure its performance. Because through these knowledge, we will be able to highlight high risky areas. We can highlight high risky area through analytical procedures. What does mean by analytical procedures? Analytical procedure mean comparing current year financial statements with the previous year financial statement. Through this, we can highlight high risky areas. How? Suppose if we have compared current year financial statement sale figure with previous year sale, and we have found the current year sale is increased as compared to previous year by 20%. Up to 10% sale is normal due to price inflation. 10% increase in sale is normal. This is due to price inflation because every year 10% prices increases. That's why our home rent increases 10% every year. But if sale has increased more than 10%, this means there are chances sale could be overstated. To highlight company profitability, this sale is a high risk area. How we have identified by comparing current year figure with previous year. We compare total assets of current year with previous year. Where are assets in balance sheet? And we have seen there is a 50% increase in asset as compared to previous year. This means company have bought new asset during the year. If asset has increased, depreciation expenses should also have that much increase. Because if asset has increased, so depreciation expense will be more as compared to previous year.
But if you bought below depreciation,
If you have bought during the year, this means you need to charge depreciation for the current year of the new asset as well. It will be having same depreciation. But while comparing depreciation expense, we have identified that depreciation expense is the same as compared to previous year. This means either asset has been overstated or depreciation expense has been understated. To highlight the profit, these are risky areas we will highlight. We will check in more detail during audit. But now only we are highlighting where we need to perform more detailed work. We checked sale has been increased by 20% as compared to previous year. This means cost of sale should also have been increased. Selling and distribution expenses relating to sale should also have been increased.
Yes, sir.
But if there is no that much increase in selling and distribution or cost of sale, this means either sale is overstated or cost of sale or other expenses could be understated. Mean we have highlighted these as high risk area. This is called analytical procedure. Mean comparing current year figure with previous year and highlighting any unexpected fluctuations. Because up to 10% fluctuation in sale is expected, normal. But if it's more than 10%, it is unexpected. Might be company have attracted new customers, might be they have increased their sale volume, but we will see later on during the audit. Currently, it is seems like high risk area. There are chances of fraud. Chances of, I mean, based on the chance we are highlighting. We can highlight high risky areas through risk assessment. What is the risk assessment? There is a topic called audit risk. And how we can highlight through audit risk, we will discuss later on. This is a bigger topic. We can highlight high risky areas through determination of a framework. What does mean by framework? This word is framework. My system stopped. Come on. It's processing. So what does mean by framework? Framework mean accounting standards. In IAS, IFRS mean we will take knowledge, determine mean take knowledge about the accounting standard that are applicable for the company. Through identification of accounting standard, we can highlight high risk areas as well. Like company has obtained leases. And on leases, there is accounting standard IFRS 16 that you will learn in later stages of your ACCA. So if company is not complying with IFRS 16, there could be chances of misstatement. So through knowledge of accounting standard, we can also highlight risky areas in which our account balance relating to that standard. This means there could be chances if company is not complying with accounting standard. These account balances could be stated. After highlighting risky areas through audit strategy, we will be able to define audit plan. After highlighting risky areas through audit strategy, we will be able to define audit plan. What is audit plan? Detailed procedure plan about how to conduct the audit. Just give me a moment. My laptop is not responding properly. It could be due to this. Okay. So what includes audit plan? Audit plan, we will include identification of critical areas, mean risk of high risky areas that we have identified through audit strategy, we will put into the audit plan. Because this is the main plan that we will give to audit team. According to this plan, audit team will start their work. So we'll include the risk of the critical area, mean high risky areas that have identified through audit strategy, we will include a list in audit plan. We will define preliminary materiality levels. How we can define preliminary materiality levels later on. And we will define nature, timing, and extent of audit procedures. Nature means where audit team should perform tests of control, where they should perform substantive procedure. Substantive procedure means detailed work. So those areas who are high risky, they should perform substantive procedure mean detailed work. And those procedures that are not high risky, they should check a little bit through test of control, whether their controls are working properly or not. We will define timing of the audit. Timing of the audit means which area should be tested at what time. Which area should be tested in interim audit, mean before the year end has finished. Which area should be tested in final audit, mean after the year end has finished. When balance sheet is prepared before year end, after year end. After year end, this means balance sheet items should be tested after year end, and income statement items can be tested before year end. Balance sheet item cannot be tested before year end because all the figures are of year end. Which area should be tested at the final day of the year end? Like inventory and cash at bank. Inventory in the balance sheet mean at year end 31st December, company is having this inventory. So we should count that inventory at 31st December. We cannot verify inventory before 31st December or after 31st December because there is movement. Cash at bank in the balance sheet is the cash in bank at 31st December. So we should count or confirm from the bank at 31st December. We cannot count cash in hand either before 31st December or after 31st December because there will be movement. And we will define extent. Extent means sample size. Mean where we should check more transaction, means sample size should be large. And where we should check a small number of transaction, means sample size should be small. The areas where risks are high, we should perform more testing, means sample size should be large. And the low risky areas where there are no chance of misstatement, we should also check them, but through small sample size, mean only 2 to 5 transactions, not more than this. So main audit plan is defining nature, timing, and extent of audit procedure. And we will brief this audit plan to audit team, like who will perform what kind of procedure on what area, at what time, and how much. And if audit team will work as per this plan, audit will be completed within time, within cost, and on quality basis. I mean, this is the main direction of audit team. We will call it response to risk. Mean against risky areas, what could be the auditor response? Mean what kind of procedure he should perform, at what time, and how much. Extent mean how much, mean how many transaction auditor should verify, either based on large sample, either based on small sample. So per ISA 300, before starting the audit work, there should be audit planning. Audit planning mean to highlight risky areas and direct the work of audit team. Because if there is a direction of audit team work, audit could be completed within time, within cost, and on quality basis. If there is no direction, might be team is stuck during the audit. There will be delays, there will be more cost of the audit staff member, or might be they miss some of the high risky area that will result into poor quality of audit. So what you need to do in audit planning, you need to prepare audit strategy, mean highlight high risky areas. How we can highlight high risky areas through understanding the entity and environment. What does that mean? Taking knowledge about nature of the company, taking knowledge about internal control system, taking knowledge about industry regulations, taking knowledge about objective strategies and business risk, and knowledge about management method used to measure its performance. We can highlight high risk areas through analytical procedure, comparing current year financial statements with the previous year to highlight unexpected fluctuations in account balance. Because those fluctuations could be misstatement. We can highlight high risk areas through risk assessment, mean through audit risk, how we will learn later on. We can highlight high risk areas through obtaining knowledge about accounting standards. And the areas that we have highlighted risky from this audit strategy, according to that, we will prepare audit plan. What is the audit plan? It's detailed procedure plan about how to conduct the audit. Mean we will write down procedures for the audit team that they need to follow to test financial statements areas. And in audit plan, we will include the list of critical mean high risky areas that audit team should be aware. These areas should be work more, should be tested in more detail. We will define preliminary materiality levels. We will define a nature, timing, and extent of audit procedures, and we will brief all these things to the audit team so that audit team should work according to these plans so they can conduct audit quickly, within cost, and on quality basis.
Audit plan is based on audit strategy.
Obviously. If we try to differentiate between audit strategy and audit plan, audit strategy means to highlight high risky areas and direct the work of audit team. What is audit plan? Detailed procedure plan about how to conduct the audit. Audit strategy define scope, timing, and direction of audit. Audit strategy define scope, timing, and direction of complete audit, while audit plan define nature, timing, and extent of audit procedures, not the complete audit. Mean through audit, you will define scope of audit, whether we need to perform more work or lesser work. Timing, whether this audit will require more time or lesser time, depending on the risky areas. If they are more, we need more time. And direction, whether this audit will be high risky or low risky. If it is a high risky, we should assign more experienced staff. If there are few risky areas, we can assign even less experienced staff. Audit strategy will define scope, timing, and direction of the whole audit rather than on which account balance we need to perform what procedures. That is a small part of audit. While audit plan define nature, timing, and extent of audit procedures. Means against what account balance we need to perform what procedure at what time and how much. So we have made 2 points regarding differentiation. Third point, audit strategy is prepared before plan. Mean plan can be defined after audit strategy. Because without highlighting high risky areas, we cannot prepare audit plan. But audit plan is more detailed as compared to strategy. Audit plan is more detailed as compared to audit strategy. How? Because audit strategy include only highlight high risky areas, mean list of risky areas. While plan include risky areas as well as response to risk. In audit approach is also defined in plan. That's why plan is more detailed as compared to strategy. Because strategy include only risky areas list. While plan include risky areas list mean critical areas as well as response to risk mean how to verify that in. Strategy include this, while plan include this. So we can differentiate between audit strategy and plan. Now from these, we need to take detail of certain areas. We need to take detail of understanding the anti-environment that we have covered. We need detail of analytical procedure. we need detail of audit risk, and we need detail of materiality. In these 4 areas, we need to cover in more detail. So understanding the anti-environment we have covered. Now we are moving towards covering analytical procedure. Analytical procedure. What does mean by analytical procedure? Analytical procedure means, in short form, we can say AP, analytical procedure. To compare financial data with financial data, financial data with the non-financial data, and ratio analysis. Analytical procedure means to compare financial data with financial data with non-financial data, and ratio analysis to investigate unexpected fluctuations. Which could have resulted from misstatements. Analytical procedure means to compare financial data with financial data with non-financial data, and ratio analysis. Mean comparing current year financial statements with previous year financial statements. Why? To investigate unexpected fluctuations, mean if there is any fluctuation change in any account balance and that is unexpected, so which could have resulted from misstatement, mean that will be high risky area. What is meant by financial data with financial data? Comparing current year financial statements with the previous year financial statements, with the budgets of the company, with the industry average, mean comparator financial statements. Financial data with financial data comparison mean comparing current year financial statements with the previous year financial statements, with the budget of the company, or with industry average, mean comparator financial statements. Because if this company sale has increased by 20%, whether the other company like competitor sale has increased by this percentage, if their sale has declined and they have increased 20%, this means this is not realistic. If company budget planning is showing a sale will be increased by 5% while actual showing 20%, this means there could be chance of misstatement in actual. It's not aligned with the industry average or with budgets. What's meant by comparison of financial data with non-financial data? I mean, comparing current year financial statements with the department's statistics or summaries. Department statistics are summaries, because those department statistics or summaries are not financial, they are non-financial data. Like current year is 2023, while previous year was 2022. In previous year, companies' wages was 600, while in current year, companies' wages figure is 700. This means these has been increased. What could be the reason for increase in wages? Either company have appointed new employees or company have increased the wage rates. We asked the wages department whether you have increased the wage rates. They said, yes, we have increased the wage rate by 10%. What is 10% of 600? 60. I mean, this should be 660. What are in the financial statement? 700.
Yeah.
Whether you have appointed new employees? Yes. Can you calculate their salaries for us? Yes, their salaries are 40. There is no unexpected fluctuation. This information we are obtaining from wages department, that is called non-financial data. In wages department statistics are someplace. But if wages department has provided us information that new employees' wages are 140 rather than 40, this means this should be 800. How much they are stating in financial statements? 700. It is expense or income? Expense. Company try to understate it to highlight their profit. This means wages are high risky that we need to verify in more detail during the audit. Why this is up? Might be they have removed some of the employees, but that will be identified during detailed testing. This is called comparing financial data with non-financial data so that we can highlight high risk areas. And ratio analysis. There are some account balance in the financial statements. We cannot get exact idea about the change by just comparing the figure. We need to calculate some ratios like comparing GP of current year with the previous. We cannot get a detailed idea. We can get a detailed idea about increase, decrease by comparing GP margin of current year with the previous year. How we can calculate GP margin? GP over sale into 100. We cannot compare debtor figure of current year with previous year to get detailed idea. We need to calculate debtor days, and then we can compare debtor days has been increased or decreased, and then we can identify whether there is any misstatement or not. We cannot simply compare profit of current year with previous year. We need to calculate profit margin and then compare to get a best idea. Similarly, we cannot compare sale figure. We need to calculate sales growth percentage, mean ratios. So there are three types of analytical procedures. There are three techniques used in analytical procedure. One is comparison of financial data with financial data. Other is comparison of financial data with non-financial data. And third one is ratio analysis, that is also called plausible relationship. Because about certain account balances, we cannot just comparing the figures and get true idea. We need to calculate the ratios, and by comparing the ratios, we will able to get best idea whether there is any chance of misstatement or not. What would be the ratio? Sale growth, GP margin, profit margin, current ratio. We have learned these ratios in financial accounting. There was a chapter of ratios, ratio analysis.
Is it part of this paper?
Is that part of this paper? That's why you need calculator in this paper as well. You might be need to calculate some of the ratios during the paper. We will practice. We will practice. We don't have paper tomorrow. We have enough time till exam. So what is mean by analytical procedure? Comparison of financial data with financial data with non-financial data, and ratio analysis. Why? To investigate unexpected fluctuations, because those could have resulted from mistake. Analytical procedures used during the audit at three different stages of the audit. Stages are levels of audit where analytical procedures can be used. Mean where auditor perform analytical procedure, mean compare data with previous or calculate ratios. Analytical procedures are used at the planning stage. Why? To highlight high risky areas. It is a part of audit strategy, and these are compulsory to perform at this stage. Mean mandatory. As per ISA 300, we should perform analytical procedure at the planning stage to highlight high risk areas. Analytical procedure can be used during the audit. Analytical procedure can be used at final review stage. These are compulsory at the planning stage and compulsory at the final review stage. What is final review stage? Before signing the audit report, engagement partner perform hot review. Mean he will check audit team work. How he will check? He will see the working paper as well as financial statements. And he will see if there is any change in a figure of financial statements. He will see in the working paper whether the team has obtained evidence for this or not. If there is any unexpected fluctuation in any of the account balance in financial statements, he will see in the working paper whether audit team has evidence regarding this change or not. Mean to see whether more evidence is required or not. Why he should perform? To see more work is required or not. Why should perform at planning stage? To highlight risky areas. Analytical procedure can be used during the audit, but here these are not mandatory. It's on the auditor. If he want to perform, he can, otherwise he don't need to perform. An auditor perform analytical procedure mean compare data of current with previous, calculate ratios before substantive procedure. What is meant by substantive procedure? Detailed work. What does that mean, detailed work? Like if a figure is appeared in the financial statements as a sale, we will see whether the similar figure in trial balance. Behind trial balance, what is that? We'll see in the ledger. Behind ledger, what is that? Journal entry. Behind journal entry, there should be sale invoice. There should be good dispatch note. There should be order from the customer. If the figure is in sale, the similar figure should be in receivable ledger or cash book as well. So tracing the figure backward to all the documents, that is called substantive procedure, mean detailed work. And this required too much time because you need to move where the documents are. You need to move there and check and verify things. So during audit, before substantive procedure, mean before performing detailed work, what auditor do? Auditor perform analytical procedure. Like before starting substantive procedure on wages, what he will do? He will compare the wages of current year with previous year. If previous year wages was 600, current year wages are also 600. Do we need to perform substantive procedure? No. If previous year wages was 600, current year wages are 700. So we can check certain things, why this has been increased. Could be due to increase in wages or due to new employees. And if it is verified that 700 is accurate, we don't need to perform substantive procedure. If it was verified, it should be 800 instead of 700. This means now we need to perform substantive procedure. We need to check in more detail how this 800 has been calculated. Meanwhile, auditor perform during audit before substantive procedure to reduce or eliminate substantive procedure. Mean by comparing current with the previous, we can identify whether we can reduce or eliminate detailed work. Because if the figure is the same or the reason behind the change has been identified, so there is no need to perform substantive procedure. Mean we can reduce our work through substantive procedure if we perform before substantive procedure. If we don't perform, obviously we need to perform substantive procedure then. So before substantive procedure, what auditor should do? They should perform analytical procedure. Mean compare figure with previous year. Check about the reason behind the change. If that reason is expected, justifiable, this means substantive procedure has been eliminated. If that reason is not justifiable, this means you need to perform substantive procedure now. It's optional. It's on the auditor. If he want to reduce his detailed work, he can perform. When we are performing analytic procedure at the planning stage, its name is analytical procedure. Comparison of financial with financial, financial with non-financial, and ratio analysis. If we are performing at final review stage, its name is analytical procedure. But if we are performing analytical procedure during audit, its name will be changed. Its name will be called substantive analytical procedure. The work is the same, comparing financial with financial, financial with non-financial, and ratio analysis. But only name will be changed as we are performing these before substantive procedure. So its name will be changed to substantive analytical procedure. What is the purpose of substantive analytical procedure? To reduce or eliminate detailed work. Means with this, we can either reduce or eliminate detailed work, means substantive procedure. Analytical procedure. There are some problems with the analytical procedure, limitations in analytical procedures.
Purpose of analytical procedure is to reduce detailed work.
Detailed work during audit.
Oh.
Reduce or even eliminate. There are some limitations of analytical procedure, especially at the planning stage. Normally, auditors do planning before starting the audit work. Suppose client year end is 31st December and your appointment is in August. This means you will do planning in August. Mean you will highlight high risky areas in August. You will perform analytical procedure in August. How you can compare current year data with previous year, because in August, complete year data is not available. The data will be available is called draft data. Mean estimated data. And if there is a major difference between draft and actual year end results, your planning will be disturbed. So this is one of the limitation due to draft data before year end. Because the complete actual data will be available at 31st December only. Before that, if you need financial statements, that will be draft estimated financial statements, not actual. And there will be more differences between actual and draft, your planning will be disturbed. Who is providing you draft data? Company management. And if they deliberately misstate some of the figures to show very good draft data, so there could be issues to highlight high risky areas through analytical procedures. So deliberate, misstatement or manipulation. Instead of word misstatement, we can use the word manipulation by management in Draft data could also affect the audit planning. What else? What else? Could be the limitations, especially at the planning stage. To compare current year financial statements with previous year statement, the financial statements, you need detailed knowledge about the client business, so that you can identify what could be the proper justification, what could be the expected fluctuation. If you don't have detailed knowledge, you can only compare the figures, but cannot have the justification for the change. So might be there are lack of detailed knowledge about client business. If there is lack of detailed knowledge, you cannot even compare account balance and highlight the expected or unexpected fluctuations. Sometimes company system is not so designed that you can obtain even draft figures before year end. If you cannot obtain draft figures, so you will not be able to highlight high risk areas using analytical procedure. So restriction, system restriction. Obtain draft data. So we have covered this topic, analytical procedure, in more detail. What are the three types or three techniques used in analytical procedure? Comparing financial with financial, financial with non-financial, ratio analysis. At what levels during the audit we perform analytical procedure and why? Planning stage to highlight risky areas, during audit to reduce or eliminate substantive procedure, at final review stage to see whether more work is required or not. And there are four limitations of performing analytical procedure, especially at the planning stage. Let's move toward audit strategy, audit plan. So we have covered analytical, understanding the entry-ends environment, and we have covered analytics procedures. Now moving towards not risk assessment, materiality. What is materiality? Materiality means misstatements are material if they influence economic, if they influence economic decision of user. Who uses materiality concept? Auditor use the materiality concept. When? When he need to decide whether he should give opinion in favor of the company, mean financial statements give to and fair view, or he should express opinion against the company, means say financial statements do not give to and fair view. So while deciding he should express opinion in favor or against, he used materiality concept. If there are material misstatement in the financial statement, misstatement means fraud errors, and there are material, auditor will say financial statements do not give fair value. If there are misstatement in the financial statements, but that are immaterial, mean not material, auditor will say financial statements give true and fair value. So what does mean by material? Material mean big, large. Mean those misstatements are material in the financial statements that influence the economic decision of user. And if any misstatement is not influencing any decision of user, economic means relating to money, that misstatement be considered immaterial, mean ignorable. means small. That's fine, it's okay, leave it. But if there is a material misstatement, this means financial statements do not give credit faith. There is no precise mathematical definition of materiality. It varies client to client, auditor to auditor. There is no precise mathematical definition of materiality. While conducting audit of small store like Al Madina supermarket, we have identified a misstatement of 50,000. And we express financial statements do not give true and fair view, mean we considered it material misstatement. While conducting audit of Carrefour, we identified a misstatement of 1 million. And we express financial statements give true and fair view. Mean that 1 million is not material. Mean for Al Madina, 50,000 is material, and for Carrefour, 1 million is not material. Mean materiality vary from company to company, user to user. There is no precise mathematical definition of materiality, mean what amount is material. It varies from company to company, auditor to auditor. In Al Madina store, we considered 50,000 as material misstatement. In Carrefour, we considered 1 million as immaterial misstatement. Why? If suppose we are conducting audit of any client and we identified 20,000 of misstatement, whether we should consider it material or immaterial, we are confused because it varies client to client, company to company, auditor to auditor. How we can see whether this 20,000 is material or not? There are two ways to check materiality. One is called quantitative materiality. And other is called qualitative materiality. Quantitative materiality and qualitative materiality. Quantitative materiality means checking materiality in terms of amount or size, like whether 20,000 is material or not. Qualitative means checking materiality not in amount or size, checking materiality in nature of transaction, not the amount or size. If we are checking quantitative materiality, we use to check through our rule of thumb. What is our rule of thumb to check quantitative materiality? We will compare the misstatement with the profit of the company. If it is 5% or more of profit of the company, we will consider it material misstatement. If it is less than 5% of the profit, we will consider it material. Al Madina profits are in lakhs. The 50,000 become more than 5% of the profit. That's why we say financial statement do not give and fail. Carrefour is operating all over the world. And their profits are in billions and trillions rather than in lakhs. So 1 million is not 5% of profit. That's why we said financial statements give true and fair view mean 1 million is not material. I'm saying 1 million, treat it 1 lakh. Take it 1 lakh. Instead of 1 million, take it 1 lakh.
Is 5% for all companies.
For all companies. This is the threshold.
Like for Apple or Microsoft.
If you have identified any of the misstatement for any company, you need to compare with profit of that company, not with other company, profit of that company.
Their profit is like 100 billion, right?
So if you have find any misstatement that is less than 5%, you will consider it immaterial.
So like 1 billion.
You can consider it immaterial because it is not influencing decision of the user. Which is material, that is 5% or more of profit. Below this, immaterial. Not only we should compare with the profit, we should compare with the revenue of the company as well. And the threshold is 1% or more of revenue will be considered material. For balance sheet item, we cannot compare with profit or revenue, like goodwill. We should compare with total assets. And for total assets, 1% or more of total assets will be considered material. If any misstatement is not meeting 5% of profit, we will compare with revenue. We will compare with total assets. If any of the threshold is meeting, that will be considered material. If none of the threshold is met, then we will say immaterial. But not only we should check quantitative materiality, we should also check qualitative materiality, mean nature of transaction. What does that mean? Non-compliance with law and regulations. L and R stands for law and regulations, and IAS, IFRS will be considered material misstatement, whatever is the amount. There is IAS 1 says director transaction should be disclosed in the financial statements. And if directors have performed any transaction with the company, there should be disclosure in the financial statement. Directors have performed $10,000 transaction with the company. Company's profit are too much large. That is not even 1% of profit. So quantitatively, it's immaterial. But from qualitative point of view, it is considered immaterial misstatement. Directors are saying it will look imbalance, like only 10,000 transaction we are going to disclose. Though quantitative point of view, 10,000 is nothing. But if accounting standard says you need to provide disclosure and you are not providing that disclosure, that will be called material misstatement through qualitative point of view rather than quantitative. Can you understand this? Materiality. What is meant by this preliminary materiality levels? At start of the audit, what we do, we calculate 5% of the profit. Suppose company profit figure is a 10 lakh, we will calculate 5% of profit and we will write that figure. We calculate 1% of revenue and we will state that figure. We will calculate 1% of total assets and we will state that figure. And these figures we will give to our audit team. And we'll ask them if you have identified any misstatement during the audit, instead of calculating 5%, 1%, 1%, percentage, just compare with these figures. If that misstatement you have identified is below than this, consider them immaterial, ignore them. And if any figure is above them, consider them material. This is mean preliminary materiality level, mean defining preliminary materiality level. Mean at start of audit, we just calculate the figures, 5% of profit, what is figure? 1% of revenue, 1% total assets.
So profit last year.
If not current year. If we have identified any misstatement during the audit while performing detail work, we will compare with these figures. If that misstatement amount is below than this, we will consider immaterial. If above than this, we will consider them material misstatement. Instead of audit team is calculating percentage. So that's enough for today. Regarding materiality, there is a one small concept called performance materiality that we will cover in next class. And we will cover very important area that is audit risk. See you next class then. Class is every Tuesday. There are some weeks where we will be having class on Friday as well, that I will inform in the group at least one day before the class. Every Tuesday, 6 to 9.
Okay, sir. Thank you.
Thank you. See you then.